didn't see you, and a number of others. So again, welcome to this day. As we get the technology up and running, I think I will just give it a start, but we'll be able to continue with this even as we proceed ahead. Right. So this is a very interesting time. We are going through a very different time compared to what we've seen before. I think every 5 years we get the election cycle, and normally that becomes the big elephant in the house for us, even as we look at how the year begins. But this year we have got the election cycle, but we also have the issues happening in Europe, and so we are faced with sort of a twin elephant issue here. And why that's important is because the NSE attracts a lot of international investment, especially the foreign investment who trade in the market, who at the moment account for about 55%. And what we're seeing currently, as you're all aware, markets, especially the US and Europe, interest rates are rising, and so we are seeing an attrition of funds or a relocation of assets from markets such as emerging and frontier markets into the more developed markets. There's definitely challenges facing the general economies because of supply chain constraints, economic downturns. We're looking at a potential very high inflation rising in Europe and the US. There have been talks of a recession, and all this is very key to us, because those investors are also the investors who participate actively in our market, and we have to be conscious of the trends happening out there. And so that becomes one of the key concerns we have, even as we present this barometer report. And the other key concern, of course, is the elections, and we'll be giving you some analysis of how the elections data, which is affected by election, and how they're trending, and why we think it's an area that we also have to pay some attention to, noting, for instance, that it presents great opportunity for investors to come in, given the current valuations that we're seeing. Okay. So I'm sorry for these slides, tech challenges sometimes, but I'll basically be able to share with you the slides as we go ahead. So the NSE is a leading market in Africa. We are among the top 5. I think we just want to lay this for emphasis. If you look at Africa today, you can actually break it into 4 key sub-markets. So in the North, East, West, and South Africa. And within the East and Central Africa region, the NSE occupies a leading position as the leading market in this region, and among the top 5 in Africa. So we have a very, I would say, a key obligation to ensure that we enhance developments of markets in East and Central Africa. And that's why we work very closely with our partners, in these various states, to ensure that we provide some level of direction in terms of how the markets trend. And so with that positioning, I must say that we are doing a lot of things to advance the market, and we'll be able to share with you some thoughts as we go ahead. But as at the close of June, our market value was about 1.9 trillion in the equity space, and about 3.3 trillion in the bond markets. We still have affiliations with very many exchanges, and also with international bodies, with the World Federation of Exchanges being our key membership, which we are proud to say has really helped us strengthen our positioning, especially at a global scale. We currently have about 8 products that we offer in this market. And I'll just highlight these because they're not visible on screen. You're familiar with our equities, bonds, real estate investment trusts, exchange-traded funds, derivatives, training, data, and the Ibuka. We also used to manage the Emakiba platform for a while, and as you may already recall, it was a good success, and we are really engaging with the government to see whether we can actually restart this platform again. We are represented in all sectors in the economy, and that's why we call ourselves, this report is called the barometer, because it gives you an indicator of the various aspects happening in the economy. So at a global scale, I'm sure you're all familiar with what's going on the data side of the globe. The economic growth is projected to come down to about 3.6% from 4.4% based on IMF data. And a high attribution of this is to what's going on in the globe, the Russian-Ukraine war that is still escalating. Now, this has affected serious flow of business, especially around disruptions. We're seeing increased refugees in the various regions. The sanctions don't seem to have really helped at the moment, but there's still a bit of exertion on that. And this has led to sort of a global, it has had a very endemic effect on the global scale. And as you're aware, the price of key imports like oil have been trending up. We're seeing certain strains on supply of raw materials. A lot of the challenges we're facing, especially coming from Europe, is a lack of raw materials and also products, especially wheat, which is a key produce of the Ukraine nation. And this has had a very, very big impact. On interest rates, we've seen the US government, for the first time, increase the benchmark rates by about 0.75%. And this has had significant impact on what's going on in the US. Inflation is actually rising in the US. I think the last time we checked, it was heading to 9%. And as this continues trending up, then you'll see a lot of effort to tame it down using interest rates. In the UK, the Bank of England increased the bank reserve rates by about 25 basis points. And we also saw a country like Switzerland, who for the first time in 15 years increased the rates by 50 basis points. So this is just an indicator that there's a huge economic challenge going on, and largely as a result of the war that's happening in Europe. So at a macro level, all subcontinents are experiencing downturns. In the US, for instance, we're looking at about a projection of 4%. In sub-Saharan Africa, we're looking at a projection of about 3.7%. In Kenya, we are now looking at a projection of around 5.5%. So this is not unique to Africa. It's not unique to Kenya. It's actually a global matter, and I think it's important that in this forecast we factor that in. Global markets have not been left behind. So today we are witnessing again a dip across all markets. For instance, if you look at the Nasdaq, it's down 28.64% as of June. If you look at the Dow Jones, it's about 14.71%. Look at the FTSE, it's about 3.77%. The Russian exchange, the MOEX, is about 37.21%. And even the Shanghai is about 7.64%. So all markets are trending down. And so I think we want to just put it across that this is just indicative of what's going on in the markets, in the economies across the world. And so the NSE ranking at just about 30% is also indicative of what's going on. And this presents great price points. And that's why we keep telling, I think we've created we've been accused of having a very confident narrative about this market. But I must say that presents attractive investment opportunities where multiples of less than 10%, less than 10 times are presenting themselves, and very, very attractive investment opportunities. And that's really what we want to have here. African markets, again, have all been experiencing some level of downturn. Our peer markets like Egypt is about 27.55%. We're at about 20.59%. If you look at markets like Morocco is about 13%. The only market with an upside is Nigeria at the moment. And again, these are unique and maybe just isolated performances. But generally, markets across Africa are also experiencing similar trends cutting across. So where does NSE sit when it comes to its market ranking globally? So we are part of the MSCI Frontier Market Index. And the markets globally are structured into three. We have the developed markets, we have the emerging markets, and the frontier markets. So the NSE is a constituent of the frontier markets. Other members who we consider peer to us in that market is the Egyptian Stock Exchange, the Kuwaiti Stock Exchange, the Nigerian Stock Exchange, and ourselves. Our ranking in that market is about 9.49%, which puts us just above among the top 5 in terms of weighting. And we have also some of our listed companies. I think there are 4 of them who are also on the MSCI index. And so we're happy with that ranking because it positions us to attract international capital, and we'll continue to do things to ensure that we retain our strong ranking, because our aspiration as the NSE is to actually be a member of the emerging markets index, and that's something that we're working on to ensure that we achieve that. We have achieved great milestones to achieve that, especially in terms of product development, governance, structures, liquidity tools. And so what we're focusing now is to increase the number of listings in the market. On the operating environment in Kenya, I'm sure you all get this data, but just to re-highlight it is just to say that estimated growth in Kenya is about 6% in terms of growth, inflation at about 7.9%, and our reserve rate is about 7.5%. This 6% is attributable to recovery of some of our sectors that were largely affected by the COVID crisis, especially tourism, where we are seeing increased arrivals. I think we are heading back to 2 million arrivals a day. And we're happy to see leading brands coming into Kenya. If you look around you at the NSE now, there's a new hotel coming up called the Marriott, JW Marriott, and we are going to be, I think, the country in Africa, the second country in Africa to have a JW Marriott brand, a very, very leading brand, top hotel in the world. And so that presents ourselves as a very attractive destination for investors and hence, for tourists, and hence we expect to see good arrivals. On the agriculture sector, again, we've had certain challenges, a bit of a muted growth there, but largely affected by the drought effects that we are just coming out of, and the cost of inputs. This has been a key area of concern, and we hope that the government is going to be able to subsidize inputs for farmers so that we can increase our level of production. I think Kenya happens to be a major producer of key crops. Tea and coffee, for instance, have been our major export crops, but we're looking at horticulture and other products that are now becoming increasingly attractive. Inflation is at about 7.08% against a target ceiling of 7.5%. And we think this is largely imported inflation because of the oil input, which is a key constituent of it. And hence, this is going to continue trending with the issues around the oil trends globally. Exchange rate at about 117 shillings, mean rate at the moment. I think this, again, in our view, is largely as a result of the strengthening of the dollar. As you know, when the dollar strengthens, then we see the shilling also losing ground. But if you look, it's more of a mixed performance because against the sterling pound, it's been strengthening, which again is a good indicator. But generally, the dollar is strengthening against all major currencies in the world, and that's really the effect. And it's because of the reallocation of capital back into U.S. bonds globally, at a global level, and that's really the impact. Various sectors are showing different levels of growth. This is a slide that I think will be able to just give you an indicator of how the sectors are performing. But I think the ones that stand out for us is really the tourism and the agri sector that we are watching very carefully as we go into this. Now, on terms of market performance, this year, because of the challenges I mentioned, our market is highly correlated to the effects of the globe. We're experiencing a level of downturn in terms of equity performance, where we are now at about 22% below what we did last year. And really this is the scenario at the moment. We however expect to see potential recovery and very good recovery as we go to the Q3, end of Q3, Q4. And you may ask me why, but I think the opportunities that the valuations that present themselves now are almost all-time lows. And hence investors, especially long-term investors, will be taking positions. I think in the last 2 days, 3 days, we've seen very good performance in the equity trading because these prices are really very, very good entry points. On the bond market, we are about 18% below last year. Again, activity is still is not as high as it was. One, because the bond rates have been rising, and hence secondary exit opportunities have not been as much. However, I mentioned that we have a 3.3 trillion outstanding bond holdings, which again, we are happy to say, well, presents a good opportunity should interest rates turn in favor of secondary market performances. So that is a market that we think is going to continue holding well. What I'm excited about the bond market is that we have given some very good, strong level of predictability for government to continue issuing corporate government treasury bonds, because we have a very, very well-automated and well-managed secondary market. Today, we are able to do three settlements cycles a day. So you're able to come in, exit in the bond market. On the equity markets, we have day trading. So you're able to, again, come in, exit. And why are we doing this? We would like to see this market become a very, very active market, especially for the retail sector, who have opportunity to take very, very short positions in the market and be very active. We also believe it's going to increase our liquidity turnover ratio, which is a key parameter for us, even as we get into as we target to become an emerging market status. How does markets perform during elections? I think this is a good question. So we put this slide for predictability so that you can assess trends. And so we looked at two different election periods. We looked at 2013 and 2017. So the blue bar is the bond market, and the green bar is the equities market. And you can see in 2013, for instance, pre-elections, turnovers were low. But 2014, markets went up. You can see both the bond market and the equity markets really, really heading up. I believe this is working now. So why is that? So what happens pre-elections is that investors don't necessarily sell. What they do, they put hold positions. Because if we were experiencing an outflow, our turnovers should still be up, isn't it? Because somebody will be selling. But right now, our turnovers are low because investors are holding their positions and wanting to just cross the line in the elections and probably be active after the elections. And that's the experience you're seeing there. In 2014, the markets had hit turnovers in excess of 200 billion within the year. In 2013, it was just slightly around 170, 180. And that just indicates for you that markets, investors don't necessarily exit, but they hold their positions and then become very active after the elections. In 2017, similarly, 2017, don't forget, we had 2 elections. So we lost about quite some months. But again, in 2018, markets performed slightly better than they did in 2017. So we're providing this chart here so that even as we put a case at the moment that markets are undervalued, it's for investors to really look at the trends, because trends provide a predictability for the future. And we believe that markets will recover and recover strongly after these elections. And that's why we advance that case that it's a buyer's market, as we always call it. The equity highlights, again, this chart just shows you how we've moved with the market capitalization trending sort of, from a high of 2.9 in last year, we're now at about slightly below 2 billion, about 1.9 trillion. But this is a number that I think we're very, very watchful over. we believe that it's a number that will continue performing and positioning us well. How we measure the size of the market is through the market cap, and we look at the market cap as a percentage of GDP. Our target at the end of the plan period is to be at 50% of GDP. Our best has been about 30%. Right now we're at about maybe 20% because of the election period, but we think this is going to be a position that will change fairly shortly. Quarter on quarter, we saw a better performance in Q2 than Q1, both markets. What are the key corporate actions that we saw during this period? We saw one of our listed companies, Centum, announce a sale of their stake in CDN Bank. We think this is good because it gives them cash back in the balance sheet for possibly taking opportunities in the public markets, and I think they'll be looking at that. Bank of Kigali gave out a dividend reinvestment plan. It's called a DRIP, and the intention is for them to target at least 5% discount on the price of the share and be able to retain the dividends. And then TPS Arena did a debt swap where they converted about $14.5 million by their leading shareholder, AKFD, FED, into shares. More of a signaling that they actually want to strengthen this market, or rather, the company. On the general performance of all sectors, I think the market cap in various sectors have been declining. But the ETF market, let me single this out. The ETF market has experienced a very good increase in terms of its market cap. And you might ask me, why is the ETF performed well? Now, the ETF that we have in this market is an ETF based on gold. So it's a commodity ETF. And the price of gold has risen from around 1,250 when we issued it to about 2,200. And again, just provides that indicator. Now, why is the ETF an attractive product? An ETF or what we call an exchange traded fund, is attractive because it's less volatile. It's a very cost-effective way to invest, and you can actually structure it on various different assets. So here we have one based on commodity. You could have it based on platinum, oil, and all these opportunities. And the one that we've issued in this market has been so successful that we were able to extinguish all the units, and the issuer is coming back to the market to issue new units for this ETF. As I said, all the other ones are showing a current decline in terms of their market caps because of the price erosions that we have seen in the recent past. Sector performance, again, the ETF has been the most best performing asset class based on trades, followed by construction and allied, and then we have the energy and petroleum. So this is how it shows, but a lot of them are still experiencing a dip in terms of trading performance. What's the level of investor participation? At the moment, I must say that we are heading towards our target in terms of the pools of active capital we want. We want to see retail come to about 50%, so that we have retail to international, local to international, about 50-50. We're currently at 58-42. And so we're going to be doing a lot of activation. Of course, I mentioned we have done day trading. So today you can buy and sell a position 3-4 times a day. I can buy Safaricom at this price, sell at this price, buy again, sell, and then whatever remains, the residue goes for settlement. And that's something that will be very, very key. And just to make this more exciting, we are today announcing that for a period of 1 month, I think with effect, is it from today? With effect from today, we are actually will not be charging on that second leg. We are giving a 1-month waiver on fees to increase activation. Okay? What do I mean by that? If you take a position and you want to exit it on the second leg, that will be free. We will not be levying as the NSE. Our partners, you continue paying the other levies, but we as NSE are making an offer today to make it, to increase activation and to just enhance day trading. So we'll actually be giving a 1-month offer for free on day trading. The price to earning ratios of this market is still very low. We are looking at about 9.54 multiples, X. And ideally, if you look at most markets, they go above 13, 14 to 15 times. What does this mean? This means that if you buy a stock today, the earnings, the dividends that you get, or the earnings per share of these companies, can actually recover your cost of investment pretty fast compared to other stocks or in other markets. So at the moment in Kenya, in Nairobi, it's 9.54 times, making companies extremely undervalued. The average yields, or the average dividend yields at the moment, most of them are heading to 10%. So it's very, very comparable to money market assets. So we think this market is extremely attractive for any investor coming in, or even those who have an exposure but wanting to reduce their average costs. The market is extremely attractive. Foreign investor activity compared to local investor activity, again, we still see a bit more dominance on the foreign space, which is a good sign, because that means there's still a lot of interest in the market, despite what's happening internationally. But we want to have a more active retail market, and that's what we're putting our case for. Local investor activity has improved post-COVID. I think during COVID, we all sat down and looked at our portfolios and saw that we needed to do something about them. So we recalibrated, and today we are seeing a higher level of local investor participation. As I said, it's about 42% compared to 58% on the foreign side. Bond highlights. I think we've had a very good performance in our bond market. It's currently at about 3.3 trillion in outstanding bonds, with the most active ones being the infrastructure bonds. I think Kenyans have now appreciated infrastructure bonds because of their tax-free status, especially for the retail investors. And you can see in Q1, the IFB was the top at 21% of total turnover. And in Q2, all the three IFBs, I think in aggregate, have about 30%, which again, of total turnover, which is a good sign that it's a very attractive bond. ETF, I spoke about it, good turnover in Q2. We're seeing the issuer bringing in more units. We are really calling on issuers to structure more ETFs, even around equities, around index, around bonds, and that way we'll be able to increase this asset class or make it very, very attractive. Globally, exchange-traded funds is now one of the leading asset classes in the world, and hence I think there's opportunity for our issuers and investment banks to structure more ETFs and bring them to the market. We have demonstrated the proof of concept. It works. The mechanics are working. We have seen a successful one, the Absa New Gold, and we think more can be issued in this market and become equally successful. So last year, we launched a market we call the Unquoted Securities platform, and this is a platform for trading unlisted assets or unlisted securities. And so our first successful case has been the Econ REITs, the development REIT and the income REIT. And we've seen increased turnover. I think this market has traded about 791 million in turnover, and really has provided a good case. So we have a market here that today, even if you're a private company and you're not ready to be listed, you can come into this market, have your shares, enjoy liquidity, because there are investors who are interested in this kind of market. And you can see how the Econ has performed in the last 2 years, to an extent that even the price has appreciated in this particular platform. So we have a lot of interest coming through. We are talking to a number of new issuers who are coming into the market, and we hope to get this more enabled. For private equity investors or companies that are being targeted by private equity, again, we think this is an attractive market because it enables you to reduce the liquidity discount that you have to pay, and so it gives you, and so it's an attractive market even for you to get better pricing, and so we'll be engaging on that. And for the cooperatives, I think we'll be able to provide an avenue for cooperative shares to trade a bit more actively by coming into this market. So it's been an attractive start, and we hope to see very, very good performance on the same. On derivatives, in trend with what's happening in the spot market or in the listed market, we are seeing sort of a drop of about 36% from 43 million to 27 million in what we call notional value. But we think this is a market that people have not yet understood about the opportunity. Now, we all know markets will recover. We all have that feeling, don't we? Or you think we're not going to recover? So if you know you're going to recover, why are you not taking advantage of buying contracts that will trend up with the market? And the markets, then you're protected on that side. You know? And I'm speaking mainly to the institutional investors, like pension funds. This is a good hedging product. If you had even protected your position by taking contracts that trend the market down earlier, today your level of exposure, loss exposure, will be lower. So I think we brought this market after carrying out very thorough analysis about performances and backtesting how these markets have performed in the past. And so even in terms of the margin requirements and all these have been properly assessed and determined. And so this is a great product to help you, protect your existing exposure. Even insurance companies who have an exposure to the stock market. Today, you're basically exposed because you will actually trend with how the market behaves. But if you have a derivatives contract around it, your level of exposure is very low. So I think it's more of knowledge, and we're trying to impart this very, very actively. And we want finance managers of all these companies to really understand or call on us so that they can understand how this product can help them reduce the level of exposure. So we brought this product to the market with a very key reason, and the rationale was to actually provide hedging opportunities. At the same time, it provides you a speculating opportunity. It provides you with an opportunity to arbitrage, move between equities, between listed and derivatives, So I think anybody who wants to become a wealthy investor, you have a whole range of opportunities here to access. And it all starts with just that being very intentional about it. Okay? Nothing comes easy. You have to take a step forward. And I call on them to look at it. We have got a market maker in this market, so if you need an exit opportunity, it is there. So it's not a market that is one-sided. It has a two-way siding. So what this market does, today the spot market trends in one direction. This one is multi-directional. Okay? So you can buy contracts that track upwards, those that track downwards. And we have about 10 of them now, and you can achieve that. What my proud moment about this market at the moment was when I saw the data being shared on CNBC. The only market in East Africa that actually is second market in Africa that's trading contracts. And so when CNBC are providing data, they provide data from the Johannesburg Stock Exchange and the Nairobi Securities Exchange. Aren't we proud of that? So media houses, please carry our data. Just that will enhance the brand and ability for people to understand this product much better. So we held a conference the other day for our chief finance officers in our listed markets, and we just discussed a couple of things on what we thought was important. Why was this conference important? We believe that the CFOs they drive the decisions in most organizations. And so we brought them together to deliberate and understand capital market financing. And some of the outputs of this outputs and sharings that we saw. People think coming to the market is extremely a challenging process. One of the panelists in that particular session said that they were able to get their approval to do a rights issue in 20 days. So you see, the conversion is also not a challenge. It's not a complex process to do it. KMRC, which is the Kenya Mortgage Refinance Company, is a 2-year-old company, and they were successfully able to raise a total of 8 billion. You know, a new company, they raised 8 billion. Of course, they took 1.4, but you can see the amount of capital they attracted. EABL was the best performing bond last year. I mean, okay, that's not the best, but the second best. But they did 37 billion against a requirement of 11 billion. And so all this just gives you indicators that this market, these products that we have in this market are attractive. Why are corporate bonds attractive, for instance? You know, when you borrow, when you issue a corporate bond, you get capital that you don't have to pay any part of the principal until either maturity or if it's got a term and end amortization structure. And that helps you when you're doing expansion. So you just service interest for the term and then pay one bullet payment at the end. And so this is the case we're putting out there. And we're seeing very positive response coming through. And we hope to see more and more bonds listed on this market. We've also brought in real-time indices. My colleague Joseph Gishuru will be providing highlights of this. But what these are doing is that they provide you with trackers, so you can actually track the market real-time. So if you want to see where the NSE 20 is at a particular time, you can basically just access it. And what this does, it helps you take what you call tactical decisions on your investment approach, because you always want to beat the index. If your fund manager is not beating the index, they should be questioned. You must beat the index. So the indices trading is really the way to measure performance, and we've got you now a real-time index that tracks the market on a real-time basis. We continue to offer governance discussions around leadership and highlighting what we want to do. Our key area here has been our masterclass and issues that we are basically providing very good input. And Jackson has done a tremendous job in bringing in corporates and institutions to train. So training is a big area for us, and we'll continue doing this. And we want to call on you to look at our calendar. So the website for training programs, it's a very practical training because it's not theory alone. We actually bring in experts who are in the business to speak to you, and you're able to get very, very good practical output out of it. So I'll pause there and invite Joseph Gishuru to just give you highlights of day trading. And remember, I did mention we've given a 1-month offer for free for day trading. So Joe, come and give them highlights just to demonstrate that this market is working. Thank you.
So, good morning once again. My name is Joseph Gishuru, take care of technology, but in our function we also are in charge of trading operations. So I'll walk you through a few highlights in follow-up to what the CEO has spoken of. Before I come to day trading, I wanted to mention, since it's the last point that Jeff spoke of, our newest product on the data space is the real-time indices. For a long time, the market has been asking for this. The end-day index is a good thing, but in a market that is moving, some of you who've been tracking the recent slight upturn on Safaricom, for instance, would know that the price is moving within the day. So when you have a real-time index on all our 3 indices, the 2 market cap weighted and the price weighted indices, then you are able to, like Jeff said, to beat the index more. Otherwise, if you have to wait until the end of the day, then you might just be overtaken. So we have an offer for that as well. Up to July 31st, we are offering free integration and consumption of the data. So we hope that all fund managers hearing this will be in touch. On day trading, If you may move to the next slide. Next, please. Day trading, we've been talking about it for a long time since we commissioned our new trading system in 2019. It's one of our flagship initiatives to drive liquidity up. And our key focus is to enable people to be able to trade shares, the same shares on the same account on the same day. So it was launched in November 2011. And really what it means is that you're able to buy and sell the same stock on the same account the same day. Those previously, pre-2021, you would not be able to do this. But now, you do not have to stick on a position the entire time. If you feel that the market is moving in the direction you'd wish, then you can, dispose of that position, take your profit, and the only position that proceeds to settlement is only the open position. And I'll give a quick highlight or example of that. So what are the key features? So the first one is, as I've said, you're able to exit positions on the same day. So if you feel that you do not want to remain on the market for too long, then you do not need to have any position that proceeds to the settlement cycle. You are able to buy and sell. You could buy 100 shares and sell those 100 shares, and the depository will have nothing to proceed to settlement. So, and then only open positions are proceeding to the T+3 normal settlement cycle. Next. So this is just an example for, to ensure that all of us are on the same page. So we have, you could always start with the long and finish the short, or short and then long. So you can buy, and this example here says that you can buy the 10,000 shares, you can say equity for instance, and then on the same day, depending on the direction the market is moving, if you feel that you do not want to stay on that position anymore, you close it out or you sell, and therefore there is no position that will proceed to settlement. The second scenario is that you start short, so you sell. You realize in our market right now, short selling is allowed, so we are not prevalidating your positions against the depository. So you can start with a short position, and all we care about is that you will not finish naked by the end of the day. So you will have either closed out your position fully to come to zero, or you will have bought some stock so that your account has got some shares. Now, what we are doing, as you all know, to encourage this is that we've provided a rebate against the square of side of the trade. So in up to today, before the big announcement that Jeff has just made, we were offering 5% reduction on the NSE levy. So that's the levy that comes specifically to the NSE. And that means that instead of paying 0.12% on that leg, then you pay 0.114%. Effective today, for the next 1 month, thanks to that announcement, then the 0.114% does not apply at all. And though that tells you, up to now, we've seen day trading contributing around 4.5 to 5% of our trading volumes or trading turnover, then that is expected to actually drive that activity even higher. So it's quite an exciting opportunity because as much as we have heard that the incentive is not sufficient, it means we have listened and then you have done something about it. So I guess that demands another round of applause, really. Thank you. So that will be it with regard to day trading. I will speak briefly about the security lending and borrowing. This is another, exciting initiative. Really a market initiative, but led by the depository, because ultimately they hold these securities. But we are saying that this is also something to watch, because with securities lending and borrowing, those holding shares for the long term don't need to sit with them for all that time. They could always make some money out of those shares from people who may need to borrow them. So effectively, SLB really is just the temporary transfer. Keyword is temporary. Transfer of shares from one party to another after they have agreed that those shares will be returned, and of course there is a fee to it. So there is a facilitation fee that goes to the depository, and also some, lending fee, so to speak, to the person who's lending those shares to the borrower. And of course that can be an individual or an institution, as long as you are holding, you have a CDS account that is holding those stocks. So the process of lending is pretty straightforward. CDSE has published very elaborate rules and guidelines, but it starts with you contacting your agent. Typically the agent is the depository agent or the broker. I understand not all of them are licensed as yet. There's a process of qualifying, but in due course I'm sure most of them will come on board. So you'll typically contact your broker the same way you would contact them when you need to transact any shares. And then you will submit your lending instructions, and then so the shares you are willing to lend, that means you have to state the quantity, the lending fees, and the period you wish to lend them. Then the agent, which is the depository, will confirm the availability of those shares in your account and confirm and capture the lending request on the CDS system. And then the securities are reserved for lending. That means they cannot be traded. You cannot, pledge them for lending, and then you're also trading them on the market. So they are reserved. They are put in a pool so that anyone else who would be on the other side who needs to borrow is able to be matched off. Remember, the matching parameters are the fees you are asking for your lending, and also the fees. The model is screen-based, which means you really never know who it is you are lending to. You basically come with your terms for lending and hope that there will be someone who's able to match those terms. So the other side for borrowing is really the opposite. You start with contacting your agent. You say how much you want and how much you are willing to pay for that. And then the request is added to the pool. As and when there is a match, then that borrowing request is executed. There are rules and procedures on this lending that if they stay too long and you are not really getting a match on the other side, then they will revert back to your CDS account, and they are able to and whatever collateral has been provided is also released back to you. So I guess I'll stop there for now and hand it back to the MC. Thank you.
All right, thank you very much, Joseph. Let's put a warm round of applause for Joe. Yeah, Joe, well done. Yeah, that is really good. And I believe there are good things that are sizzling. We want to remind you, let's keep tweeting. There's already some good action that is taking place out there. We've just had a great pronouncement by our chief executive. I think as he was making his speech, several things stood out. It is a value market, and this is a good time to actually be able to look at different things. He did mention different opportunities that we have within the market, from the low PE, the price earnings ratio that are there, which you could take advantage of, to the diversified market. I was just thinking, let's go for gold. Yeah, even as you can see with the gold ETF really trading very well, and of course are leading the way. And of course there are many things that he did mention, and last of course was a great announcement on day trading. So ladies and gentlemen, we have someone who will now be taking us on the second opportunity. The first opportunity was day trading, and we have the derivatives market. How do you buy long and short? I had Joe make those terminologies, and of course with the derivatives market we have quite some insights around that. So ladies and gentlemen, let us welcome Ms. Mbithe Mwema, our Chief Business Officer. Ms. Mbithe Mwema, welcome.
Good morning once again. Thank you for that introduction. I'll carry on the conversation with regards to how the market is doing. The sentiment has been negative, not only locally, but also globally. And in line with that, we've actually seen an opportunity to be able to appreciate and execute on derivatives when it comes to hedging on your portfolios at this point in time. With regards to an overview of what we saw in the last quarter, Thank you. What we saw in the last quarter, we saw a decline in turnover and volumes traded. This was down 36% compared to the previous quarter. We did 43 million with regards to the turnover for derivatives in the first quarter. This declined to 27 million, and contracts were down 21%. So what has happened in this market is really looking at what has been happening in the spot market and global markets, and with sentiment down, what has happened in the derivatives market was expected. Nonetheless, the use case for derivatives markets, especially when markets are coming down, is using them as a hedge. So for instance, if the sentiment continues to be negative based on what is expected to happen in Kenya, then you want to use derivatives to hedge your position. In other words, if you think markets are going down, you want to use derivatives, or if you think markets are going up, you want to use derivatives as well. It depends on what the sentiment is and what your call is. But over and above that, the beauty about using derivatives is your capital allocation is really low. It depends on the contract that you're trading. It could be 12 to 15% of the cost of investing in the spot market. I will illustrate this in the next slide. These are all the contracts that we have on the NSE, including the indices, that's the NSE 25 share index contract, as well as the mini NSE 25 share index. So we were looking at the contract values if you wanted to take up any of these contracts that are in the market. So we have all the banks included in these contracts, as well as Safaricom and BAT and East African Breweries Limited. This particular chart just gives you an outline. If you were to buy any of these particular contracts, what would be the contract value and what would be your initial margin required and what would be your capital allocation? I'll start with the first one. Safaricom PLC. At current prices, the contract value would be 27,400. However, because it's a derivative, your initial margin requirement would be only 13%. In other words, you would be putting in 3,600 to be able to take advantage of this. In the subsequent slides, I'll be able to show you how you can trade if you are expecting a recovery of 10% from these current prices. The same applies for KCB Group. At the current price, the contract value would be 40,580. However, your initial margin, which is the initial amount of money you'd need to put up for this trade, would be 5,300, which is about 13% of the actual capital required. In other words, what we're saying, if you wanted to trade this on the spot market, which is the main market of the NSE, you'd actually have to put in 27,400. But when it comes to the trading a contract on the derivatives market, you'd only need to put in 3,600, which is about 13% of what you'd put in the main market. Let me show you now an illustration of this. This gives you an overview of all the contracts that we have. But then the next one now shows you if you actually wanted to invest in Safaricom. This is the example that we're working with. You're anticipating a 10% recovery in Safaricom, and you want to take advantage of this. In other words, the market sentiment is down, but you are looking to expect a recovery once we get through the election cycle because the fundamentals of the stocks that are represented on the NSE are still relatively strong. How would this look like on the main market vis-a-vis on the derivatives market? The first chart shows you the amount of funding you would require. Say you wanted to buy Safaricom and you wanted to put in 25 million on the equities market, that's the spot market. For a similar trade on the derivatives market, you'd only need to put in 4 million shillings. If you wanted to put in, for example, 2.5 million again on the spot market, for this particular derivatives market, you'd only need to put in 400,000 shillings. In other words, you'd need a lot more capital to trade on the main market, but for the derivatives market, it actually helps you because you allocate less, but you are also able to benefit from the upside that tracks the main market. Let's take a look at the next slide, which shows you the trading fees that would have been applicable. If you are a fund or you come together with your friends or you are in a group and you put in 25 million shillings in Safaricom in the main market, that would have cost you 893,000 with regards to trading fees. However, if you did the same on the derivatives market, your capital allocation would be 4 million, your cost would be 89,000 shillings. Now let's take a look at the net profit, which is the chart down below the funds required. If you put 25 million on the main market and you're expecting Safaricom to go up by 10%, you would make 1.6 million in that trade. However, if you put in 4 million in the derivatives market and it went up 10%, you'd actually make 2.4 million because of your capital allocation. So ladies and gentlemen, the total return, if you were spotting the main market, would be 6% all in, which includes you making a 10% return, but some of that actually goes to your fees. But because of the fees, which are very low on the derivatives market, you'd actually be making a 61% return, having invested only 4 million shillings. So what we're saying, as markets are going up, and when it's volatile, whether you're looking at local or global markets, derivatives offer you a hedge. You put in your very low capital allocation, and the pricing on this particular market is very low compared to the main market. It gives you an opportunity to actually take a side, either go short or go long, depending on the opportunities that you see. As we continue to see weakness in the market, we are continuing to tell you and our clients to actually make an appreciation, to have an appreciation of how the derivatives market work, to look at it whether you are investing as a group, whether you are investing as a high net worth individual, whether you are investing as an institution. Have an allocation to derivatives, first and foremost, to hedge from any losses that you could incur in the spot market. But more importantly, you can stand to gain a lot more with far less capital in the derivatives market. And then finally, I'll speak about training, which is also the other thing that we are focusing on in this particular quarter. We have the East Africa Debt Capital Market Masterclass that will be happening from the 13th to the 15th. As my CEO, Mr. Jeff Odundo, mentioned earlier, as the NSC, we have been actively listening to the market and facilitating training to address capacity and gaps just to be able to showcase opportunities. This particular month, the focus has been on the debt capital markets, and this is also riding off the NSC CFO conference, where we are saying, given what is happening in the markets today, there is an opportunity for chief finance officers to evaluate the position for debt capital, and the capital markets are offering you an opportunity, whether it comes to corporate bonds or green bonds. And it's important for you to pay attention to this, come and understand how would the capital market debt issuances improve your financial well-being. So this is a class happening 13th to the 15th in Mombasa. Thank you for your time, and back to you, MC.
I think a warm round of applause from Bide, please. Thank you. Yeah, so thank you very much. And as she's been sharing with us different opportunities, that word opportunity kept popping up. And as you can see from the derivatives, you can be able to leverage different investment opportunities that you have. And then, of course, she did talk about the training opportunity, and we want you to be educated and also to have a firm grip of how the market operates. So thank you very much, Ms. Mbide, for that elaborate presentation. We appreciate that. And like we did mention from the very beginning, we're actually having people who are online as well as the audience here, and we already have some questions and even some engagements that are already there. So I'll be inviting the panel. So for those people who are here in person and you want to ask maybe any question, we've come to the plenary session, and in the plenary session you can be able to ask your questions, and then we should be able to have the different speakers be able to provide different responses. So it is your day, remember, so we want to have that engagement. So if we have any questions for the people here, then we can be able to engage. But I'll go ahead, and I can see there are some questions that have already come in, and we'll be able to start with those that have come in online. First, to acknowledge the different people who are logged in online. We saw quite a number of people saying hello and also acknowledging this whole event and also their participation. So we have the first question that has come from the trading room. The trading room, that is someone on the live chat. So they're asking, is the offer a 1 month subscription offer, or is it a life offer? So let me invite our Chief Executive, Mr. Jeffrey Odundo. He'll take that, but also allow me to also read other questions. So by the time we are being able to respond, then we can be able to take a number of them. We have Dipanka Kapoor asking, why can't we have the NSE 20 or NSE 25 index tradable? Why can't we have the NSE 20 or NSE 25 index tradable? Please have the futures and options on them ASAP. I believe that there's an answer for that. And then there's a question again on the futures by the same person. What will be the cost of carry on Safaricom futures? what will be the cost of carry-on futures? So those are questions mainly around the NSE 25 and also on the derivatives. I think maybe Joseph, you can go ahead and tell us how long is the offer for, and then Madam Bide, you can also tell us the questions on the derivatives. Thank you very much. Joseph, karibu. Meanwhile, if you are here, you can raise up your hand, and then we should have a roving mic to be able to answer any questions that you may have.
So thank you very much. I believe the question with regard to the I believe the question with regard to the real-time indices, right? Yeah. So the offer to 31st of July is the data subscription offer. So if you sign up now, we will facilitate you through the integration, which takes a very short time, and you're able to access the full-time data set for all the 3 indices up to that time. The good news, however, is even after that point in time, when you have expressed interest and we are in conversations and it proceeds to the contract phase, we still allow you up to 60 days of no payment. So effectively, you have 3 months, so to speak, to continue receiving this real-time data stream without payment. However, for purposes of the announcement, it is the data content or the subscription data that will be available only for that 1 month. Thank you. Rosiana?
Thank you for your question. For the derivatives, we have 2 types. There's the single stock ones, that's the likes of Safaricom, EABL, BAT, and all the banks. And we also have the index derivatives. For the single stock futures, we actually charge 0.17% total all-in cost. That is what goes to the NSE as well as to the brokers. Then when it comes, sorry, I beg your pardon. For the single stock futures, 0.17%. For the index futures, 0.14%. That's the total all-in cost for you as an investor. And I think I've also seen another question that was asking whether you can actually trade the NSE indices. We do have that opportunity. You can trade the NSE 25 index. We also have the mini NSE 25 index. For the main NSE 25 index, the initial contract value would be 43,000 shillings, but we have been listening to you and we came up with the mini NSE 25 index. The initial contract value for that would be 4,300. So in sum, if you're doing a single stock, total all-in cost 0.17%, which is your trading fee. If you're doing the index, 0.14 total all-in cost. Thank you.
All right, thank you very much. Thank you for that. I think the answers are succinct and we are able to appreciate that. We had made the offer. For those people who are here, you can go ahead and raise your hand, please. This is media. I don't know media for being shy. Yes, sir. All right, so we have a roving mic. So we have 2 people. So this gentleman, you can tell us your name, the media house you're from, and then you can go ahead and ask the question. And also the lady at the far end, but we can start with the gentleman. Thank you.
Okay, my name is Eric Ombok from Bloomberg. I have 2 questions. The first one is on the valuation of bonds, the 3.3 trillion shillings. Is that for both corporate and government bonds? And then the second question is what is required for the exchange to be a member of the emerging markets? And by when does the NSE aspire to reach this status?
All right, thank you, Ombok, for those 2 questions. So we'll be responding to them. We'll also have the lady at the end, the back. She can go ahead and introduce herself, the firm, media firm she is representing, as well as her questions.
Good morning. My name is Edna Mwenda from Business Daily. My question is on the CDSC maintenance fee, the 1,200 per annum. Where are you currently at, because you had suspended after the investor uproar on the matter? Yeah. I have other questions, but I'll ask him individually.
All right, thank you. Thank you very much. So we have those 3 questions. I can invite our chief executive, and he can comment. Thank you.
So that we don't go back and forth, can I tell Mbipe and Joe to stand here? and take some of these questions. So, Vita, you could possibly respond to the valuation.
Okay.
Thank you.
For the valuation, yes, it actually covers both the corporate and the government bonds. But for your information, only what actively trades is the government bonds. For corporate bonds, typically, the only activity we get is when people are coming in at the initial market, and then it stays, and the only thing that happens is at redemption, investors get their money back. But for the government bonds, especially the infrastructure bonds, there's a lot more activity on those, but not on corporate bonds. Thank you.
Thank you. Thank you very much. On the emerging market status ranking, the key requirements here is about market size, and market size is really market cap. The market cap to GDP ratio has got to be somewhere in the ranking of about 50%. We're currently at about 20%. You should have companies of certain size in terms of their market cap. I think it's about $10 million, which I think is something that you have to also look at. You also have to have a liquidity turnover ratio of about 7.5%. As part of that, we are required to have a derivatives market, which is something we have done, and also you are required to have a proper governance structure, like what we've done when we listed the company in 2014. So we are ticking off most of those requirements, except market size, which is a big bear for us at the moment, and that's why we are really working on seeing how we can attract huge listings. You're also required to have good product diversification, which we've done, and also in terms of your incentive structure as a market, it's got to be very, very accommodative, and I think that we've done very well. We don't have taxes, we don't have capital gains tax, and we've got very good incentives on listings. So we've ticked off those boxes as well. So our intention is that at the end of our plan period, which is expiring in 2024, we should be closer to this target, if not achieve it. So 2024 is where we are pointing at, and we are really hopeful that we'll be able to do that. Thank you.
All right.
The CDSC, Edna. I'll speak here as a board member of CDSC. So we had what the market reacted to. I think the intention was to really provide some level of revenue for the CDSC so that they can be able to offer even better services. But we are conscious about the current environment and the way the environment is economic times, and so a decision was taken to suspend it. I think I can't give a timeline on how long the suspension is going to be there, but I think all assessments will be done after very extensive consultation, including potentially public participation. So, so let's hope that next time there's some discussion, we'll make it a bit more open, and I believe we've had the market, and that's why the decision was taken to suspend it. Thank you.
All right, thank you, Mr. Jeffrey Odundo. And we have some more questions that are streaming in online. So if you're here in person, you'd like to have your question, kindly raise your hand. We'll be taking the last round of questions. But meanwhile, let's hear what the online questions are, and I'll go ahead and read them. So we have Deepan Kapoor. Again, what's the leverage on futures in this case of Safaricom? So what is the leverage on futures in this case? Safaricom. And then there's another question by Hassan Ali. Are we able to get a date for a new IPO? Are we able to get a date for a new IPO? We have Brian Gates, and he's asking, is the training masterclass free to attend, and is it available hybrid, online, or in person? And then we have the trading room asking, should we expect any more ETFs coming soon on the exchange? Should we expect more ETFs coming soon on the exchange? And Anthony Shaw is asking, the ABSA New Gold ETF doesn't seem to move in lockstep with gold prices in the global markets. Why is this? And is there anything being done about it? Ms. Mbide.
Okay. So who starts?
Oh, okay.
Okay. What was that question? Let me speak to the IPO, and then I'll let Mbite handle the Deepak's question, or Deepan's question on the leverage of the futures. I'll invite Jackson Kiminja, our training manager, head, to speak to the masterclass and training programs, and then Bithe will come back to speak about the ETF. All right. In fact, I'm taking the most difficult question. So the IPOs. So the IPO is a very big area for discussion. I think we've been having a lot of discussions. We are really engaging extensively with both public and private sector companies to bring these companies on board. I think you saw even recently we onboarded a director from the KEPSA, Ms. Carol Karaoke, to join our board, and this was intentional because we believe she brings in that level of access to these companies. So really, we are working hard in terms of achieving this. In terms of pipeline, I think what you're likely to see might not happen this year. Let me just be honest about that. Given the kind of period we're going into, investors would normally want to hold those decisions. But what you're likely to witness is additional corporate actions. We possibly could see an introduction of a share of a company into the market. We're going to see a company that's going to move from one segment to the other. We're probably going to see some additional offers, rights offers coming through, and that kind of thing. So those are going to be new corporate actions that are likely to happen by the end of the year. You're going to see more activity on the Unquoted Securities platform. But this platform we should all be very, very, watch it keenly, because it's going to provide us with a pipeline of future listing companies. Companies might onboard the Unlisted Securities platform, trade a few years, 1 year, 6 months, etc., transition into the main market. So I can say that engagements are going. We're working very hard to see if we can bring an IPO, if not this year, early next year. We hope the government will respond to our rallying call about using the capital markets to generate capital to support Exchequer. And all these have happened, and we are happy to see even the Privatization Commission has been reconstituted, and we are hopeful that that will happen. So let me just say, it's not too far off. I think on the very outside, we're looking at 9 months possibly, and at best 6 months. So we hope that will happen within those periods. Thank you. Bithe?
Thank you. So I'll start off. There's a question on Safaricom. So we have that as an index. So the contract value would be 27,000 shillings. And what happens is each contract you'd multiply by 100 shillings based on the price. So 27 times 100 is 27,000 shillings, but your initial margin is only 13% of that. Now, for the gold ETF, it actually tracks the global gold price. However, it is then converted to Kenya shillings, and that's what happens. If you've seen our previous chart, maybe I'll ask my colleague to take us back there, there's actually been a movement up and down depending on what is happening in gold. Last quarter was a good quarter for gold globally because of all the volatility that was happening in the market, but we are seeing a bit of recovery with regards to what is happening on sentiment, and perhaps this quarter, the bolstering of the price might not be as high. But for us, every single price point of gold every single day actually tracks what is happening globally, then it is converted to Kenya shillings. I beg your pardon. There was a question on ETFs and if we expect more ETFs. So what has happened? First and foremost, with the gold ETF, we did see a lot of demand both globally and locally, rather from local and foreign institutional investors in the last quarter. One of the weeks in June, we actually traded about $3 million worth of gold. That actually meant that the units that the Absa Gold ETF had put on the market were all exhausted. We have seen the company go out and say they want to bring in additional units to be able to meet demand. Now, on the basis of that news, we've actually been talking to investors and we've been seeing a lot more interest with regards to potential issuers. We are talking to people who could possibly issue an ETF that's more index oriented, and we are beginning to have those conversations even with the local community. And our conversation at this point is to say, for money market managers, for fund managers as well, who are also trading in equities, I think there is an opportunity for them to actually come up with an ETF that addresses the index and tracks the index and allows investors to be able to trade into that. So those are the conversations that we are having. We are beginning to see interest with regards to a possible index ETF, and we will keep you posted once this comes live.
Thank you very much, and good morning. I will take the question on the NSE masterclasses. As you are aware, or you might be aware, that the masterclasses are the ones that were introduced we introduced the masterclasses this year, and we charge a very minimal fee based on the value proposition that you are presenting to our stakeholders. However, for the debt masterclass, being the first one, we are providing it just on a physical or a class-in version, but we shall be availing an electronic version of the same on our NSE Digital Academy. In terms of the hybrid versions, moving forward, we are considering that route, but at the moment, we just want to avail the physical and the electronic version for all the masterclasses that you are providing. Thank you.
Yeah. So, yeah, any more questions?
All right, thank you. So any more questions? The last one? Yes? Okay, you can pass the mic to him. Sorry, it's on?
It's on.
Thank you.
Thank you. I love that. Anyway, so my first question is about, we saw recently the unveiling of the Nairobi International Finance Center, and there I met with the Carbon Exchange folks. They're really interested, in coming into this market. Maybe what exactly should we be expecting in that regard? Raising green finance and whatnot. And secondly, also help us understand how majority of the markets on the red, Nigeria is doing just okay. Or what is that differing, or what is setting them apart? Thank you very much.
Thank you, Noah. And now that you mentioned sustainable financing and ECG, let me also introduce Lois, who was out when you started off. Lois, maybe you can just stand. Lois is our ESG champion. She's the one who developed the ESG guidance manual that we are all using in the market today. And this is one of her expertise space. So the carbon market for us is a pretty clear market. Maybe Lois, you want to come here as well, just to introduce it. And thank you very much, Noah. So we participated with the NIFC and the Air Carbon Exchange to set up, or rather to sign an MOU to understand this market much, much better. Now, as you know, Kenya happens to be a market that has great potential on green, on carbon, positive carbon, and also green financing. And we think there's great opportunity in this scope, or in this area. And so we came together to sign a memorandum of understanding to explore various things. One, to carry out maybe a base survey on this potential, to understand the whole technology and how it operates, to understand the markets that buy these that come into these opportunities. And the whole intention is for us to set up a carbon exchange in Kenya. And that's the mandate that we have as the NSC to work to drive this. And of course, work with partners who are interested in this area. So we're going to be having that engagement. We're happy to see the NIC launch. We want to congratulate them again, because this is a very good platform in terms of attracting investors to come and set up offices here. And we're happy to see Prudential become one of the first companies to do that. And we believe all others will continue coming. There's a very good incentive structure that is coming through that has been put in place for starts, but I think more will come. But let me just invite Lois to also just make a small pitch about ESG, because ESG is big right now globally, and companies should actually be adopting more ESG standards to improve their operations. Lois, over to you.
Thank you, Jeff, and good morning. Just picking up from where Jeff left, the conversations about the carbon exchange are a continuation on the conversation the NSE has been driving on environmental, social, and governance practices, adoption of the same by our listed companies, or indeed any company that would want to walk that journey. So what the NSE has done as a member of the Sustainable Stock Exchanges is to champion the first ESG guidance manual for use by our listed companies and any other company. What that manual is we understood that our stakeholders already know what to actually do in regards to environmental, social, and governance matters. What they didn't know was the how to go about it. So the manual is a how-to document on how companies can start that journey to integrate and make it a way of life, and as well as move forward and disclose the same, tell their story to the world on what they are doing on those. And the story should be a balanced story, a story both of the good, the bad, and the ugly, indicating particularly mitigations where it's the bad on what the company is doing in all the three areas of environmental, social, and governance, providing very clear, measurable metrics on the three facets of E, S, and G. So the journey starts with the company adopting good practice, moving forward the company telling its story through disclosures, and eventually with that we'll now see the carbon exchange and the trading of carbon credits, particularly for those interested in the environmental pillar of it. Thank you.
All right, thank you. Let's put, sorry, Jeff, back to you.
Thank you. There was a last question about why, okay, despite all African markets and global markets in the red, why is Nigeria doing well? I think now this could be attributable, one, to the, what was the baseline of where Nigeria started off. Don't forget, our baseline recovery began in 2020. Beginning of 2021, we saw a very strong recovery of the markets. And I think we have then been affected by the impact of the elections, largely. So Nigeria don't have an election at the moment. I think they're having a stronger recovery based on their baseline compared to us. But significantly, I think this is basically they're going through similar periods, but at least their stocks have been holding well. The other issue that possibly I read the other day is that investors are reinvesting more of their monies within Nigeria, because Nigeria has a lot of currency restrictions compared to we in Kenya, and hence your only option is to invest in the market. So the markets just have to remain strong. But those are just sort of the highlights we have. But we can share more incisive information as to that detail in other segments. Right.
All right, thank you. So do we have another question? Maybe we'll take then the last two from the online audience. We have again Dipan Kapoor, Dipanka Kapoor. When can we have the currency futures on the NSE, USD Kenya shillings, please? And then the second question is from Kama Namai, great presentation and quarterly update will be encouraged. What is the other commodities in consideration for ETF? What is the other commodities in consideration for ETF? Thank you.
Okay. So the currency futures market is something that we had projected to also bring into the market when we set up this market. But we took a decision that it's possibly important for us to understand and also to build knowledge and education around the derivatives market. Given the high level of the impact of currencies can have across markets, we felt that let's first of all start with our own market. Let's see traction, knowledge, understanding, and in the meantime, we're also carrying out studies and discussions with the central bank and other players to really understand what will be the sensitivities of this market or the complementary effects of this market to the currency trading opportunity. So it's something that we have on top of our list, but at an appropriate time, we'll then be able to bring it on. But right now, even with our own equity markets, we have not achieved the critical number that we're looking for. And until we achieve that critical number, then we cannot take the next step. There are many other things that we think we are going to be bringing onto this market. So we've got things like options and all these kind of things. So we want to first of all achieve that critical mass, build knowledge. And by the way, you might wonder why we are where we are. Recently, we had an engagement with the Johannesburg Stock Exchange, which was our sort of partner when we were setting up this market. And they were very impressed that in 2 years, we have had a market that is actually running and active, and settlements are happening, and all the trackings are going on in just 2 to 3 years. They took 5 years before the peak began. So we think we'll be able to shorten that learning curve. And that's why we're happy to say the market has performed well for the last 3 years. All we need is to have more volume coming in, because in terms of structure, in terms of settlements, in terms of the risk framework, everything is working. So really, it's just the numbers that we need to attract, especially institutional investors. So I know I keep a lot of pressure to this team because those numbers have to make sense, but it's really a rallying call to the rest of the market. Maybe Mbide, you want to comment on the commodity ETFs? Thank you.
Thank you so much for that question. So the current ETF that we have is a gold ETF. But then the interest that we are getting from the market is more looking at indices. So either coming up with an ETF that possibly looks at either the NSE 25 or the NSE 20, and then investors, you're giving them access to over 20 or 25 counters that are listed in the market. I think that's what we've been focusing on for now. But then the other ETFs that we've also been discussing with the market are such as bond ETFs. You can actually have a bond portfolio, create a bond ETF, and you can be able to invest in it. And the genesis of this and the appreciation of this is that in global markets such as in the US, retail investors actually invest in ETFs. They'll either do an ETF that is for the stocks or maybe a particular sector such as technology or the industrial sector. They'll probably even do an ETF for bonds. And we've been seeing that interest coming from demand from Kenya into that market. So for us as a market, we're saying if you are an issuer, if you are looking to attract retail investors without necessarily giving them access to only one opportunity, you can either have the commodity, which we have for gold. You can have an index, which tracks what is happening on the main market for equities. You can also have a bond ETF. In other words, use ETFs to aggregate retail demand and create access to them in a similar way that the money market works. I hope that addresses the question, and thank you.
All right, thank you very much, and we really want to appreciate every single one of you, and also to appreciate our Chief Executive, Ms. Mbide, Mr. Joseph, Lois, and Jack for that commendable session where you've been able to address all the issues that have been asked. So ladies and gentlemen, let's put our hands together for them as we come to the end of this. Yeah, so thank you very much. A warm round of applause. Yeah, so thank you very much. We appreciate, we wish to appreciate everyone for coming, and also our online guests. I think a lot of interaction has come online. I think I learned a term, it's called hybridation. Hybridation, that means that nowadays, whichever strategy you have, it has to be hybrid. So we want to appreciate our in-person guests for the questions that have come in. Your participation has added color, and also for our online guests. So thank you very much. I would also want to mention and appreciate the teams that were behind this. The back side of it, we had Radia doing a lot of the hard work, and we had Bansri, we had Queen Bella, we had Boniface Mbogo, again, doing all the putting things together, and we really appreciate. So on behalf of the NSE, we wish to appreciate every media house that is represented here, and we look forward to make a date with you come September. Thank you very much. God bless you. We have some refreshments out for you. Asanteni sana.